Global equity markets are caught in a perfect storm of liquidity tightening by central banks, the Ukraine crisis, slowdown in China's demand, rising global inflation, and hiking interest rates. The global macroeconomic stress is reflected in the IMF latest forecast. It expects world economic growth to slow down in the next 2 years and has lowered its growth projection by 80 to 20 basis points in the April 2020 World Economic Outlook report. It also expects global inflation to surge due to the war-induced jump in commodity price. Hi, I'm Saurav Kumar, and in this video, we are going to discuss factors impacting the performance of the domestic equity markets. I'm joined by Bhardwaj of ETUL. So let us delve into it. So Samir, FIIs have remained net seller of Indian equities for the seventh straight month in April 2022 and sold over $17 billion worth of Indian equities in the first 4 months. What is the reason behind FIIs exiting Indian equities?
See, one of the reasons why FIIs are exiting right now is because of the increase in the US bond yields. Now, increase in US bond yields basically makes US markets more attractive to foreign investors. Okay, so also the other reason is the contraction in the risk premium. Now, how do we define risk premium? Risk premium is the excess return that an investor expects over the risk-free rate. So here the risk-free rate that we're taking is the US bond yield. Okay, so how do we actually come up with the risk premium? Is we calculate the difference between the earnings yield of Nifty 50 and the US 10-year bond yield. Now the US 10-year bond yield have spiked in the last 6 months. It's over 100 basis points jump in the last 6 months because of the concerns of inflation in the US economy. So basically, how do we look at the earnings yield first of all? Now earnings yield is the inverse of the price to earnings ratio. It is basically how much EPS a company generates for every rupee that an investor is willing to invest in the company. So in the US bond yield at the start of the year was around 1.62, basically 1.6. So which has now spiked over 2.9%. As a result, it is basically fallen from 2.61, which was the risk premium, which was 2.61, which was available in the month of January, to 1.85 now. So because of the reduction in the risk premium, the FIIs are exiting the market.
So let's talk about the high inflation now. How bad is the situation and how has this impacted the Indian equity market?
CPI is at an 8-year high, 7.79% in the month of April. WPI was also at a record high of 15.1% in the month of April. So these are basically the commodities. The price of commodities are rising. As a result, the input cost of the manufacturers are going up. So as a result, it is increasing the operational cost of the manufacturers are going up. Basically, hits the company's EBITDA margins as well as the profitability. The other thing is that we can also look at the raw material cost as a percentage of sales in the BSE 200 index. Basically, so that has actually gone up from 35.6% in December 2020 quarter to 39.4% in December 2021 quarter. We've calculated it on an aggregate basis. So the other thing is the Bloomberg Commodity Index. It has surged around 40% in the last 1 year and around 30% in the year 2022 so far. Now the impact usually of the rising inflation is on sectors like auto, cement, chemicals, consumer durables that have hit the most. Their operating margins have contracted because of the increase in the raw material costs and other operational expenditures. Also on the other end, the higher energy prices are also impacting power sector, then fertilizers, cement, ceramic tiles, and glass and city gas distribution sectors. Now, taking example of city gas distribution companies, most of the companies have witnessed contraction in their margins. The increase in oil prices is also going to affect the oil marketing companies.
Let's talk about some macro numbers. What is your reading about the macro data?
And if you look at the other indicators like the core sector growth has actually reduced to 4.5% in the month of March. That's the latest number available, compared to 6% in February. So out of the 8 sectors, coal and crude oil has witnessed contraction. And other 6 sectors have witnessed growth in the month of March in year-on-year terms. See, going ahead, coal and electricity sectors are expected to show healthy growth because of the growing power demand due to overall pickup in the commercial activities. Also, the government's focus on infrastructure spending, rising housing demand will also bode well for the steel and cement sectors going ahead. So as of now, the current numbers are showing that the numbers are actually low, but probably in the future they are likely to improve. Also, if you look at the index of industrial production, that's the IIP data, that has actually grew by 1.9% in March, which is marginally higher than 1.7% which was recorded in the month of February. So also, like, the manufacturing growth has been weak in the IIP. Also, the consumer durables and non-consumer durable have actually shown a contraction. This consumer durables and non-consumer durables demand is further likely to get hit because of the increase in prices. Also, the capital good numbers are also disappointing, which is showing that even the investment demand has not picked up very significantly.
Rupee has also touched a low of 77.72 against the dollar in May. Has there been any impact on equity because of the fall in rupee?
If you look at the dollar index, which measures the strength of US dollar against other currencies, has actually surged over 9% in the year 2022 so far. So the Indian rupee is losing because of the surge in the oil prices and because of the subdued industrial production and concerns of high inflation. Also, the rising inflation, the investors are expecting that the central banks may take some tough measures. So that is also impacting the performance of rupee. Basically, the impact of the weakening rupee on the India INC, if you look at that, it is likely to increase the cost of imported raw materials, which is going to hurt the operating margins of the company. The thing is that the companies which have debt in the foreign currency is also going to it will not be easier for them to service the debt.
Do you see light at the end of the tunnel?
If you look at the domestic institutional investors or domestic inflows, they are positive since June last year. The inflows of these have in the last 1 year, between say June and April, is over 1.88 lakh crores. Okay, they have partially absorbed the selling pressure of FIIs. The other thing is that the buying spree is also continuing in the month of May, and till now they have put in over 16,000 crores of of net equities. So the SIP inflows continues to be robust. In 2021-22, it was around 1.25 lakh crores, which has shown a growth of around 30% year on year. SIP has remained strong despite weak equity markets. So this is one of the you can say that even the FIIs are going out because of the macroeconomic concerns, but DIIs are basically the domestic institutional investors. They are basically covering them up. The quarter 4 numbers that the companies have declared so far are decent. Around 64% of the companies that have reported results in the Nifty 50 universe, they are above the Bloomberg consensus estimates. Sector-wise, if you look at, the private banks have reported improved performance because of the improvement in their asset quality as well as the moderation in their credit costs. The IT sector is doing well because of strong demand environment as well as good deal wins. Also, the automobile sector has also reported good set of numbers because of the price hikes that they have taken in the past, and also because of their operating leverage. So the other thing that we can look at is the GST collections. Now, the GST collections have hit a record high of around 1.6 lakh crore in the month of April. It was shown around a 20% year-on-year growth from last year. It basically indicates the recovery in the business activity post-COVID. Also, if you look at the tax revenues have jumped 34% year-on-year, around 27.1 lakh crores, which is also indicating a good economic recovery. So what I wanted to say is now, like in the short run, probably these macroeconomic concerns may be impacting the market. But if you are a long-term investor, the fundamentals of the Indian equity markets remains intact.
As we explained in this video, if you are a long-term investor, the state of economy is not that bad.
Right.
Thanks for joining us on this video. Please give your suggestion in the comment box.